Ever wondered how money flows in the world's sixth largest economy, India? It's a fascinating journey, and it all happens through the Indian financial system. This system, a complex yet harmonious web of institutions, markets, and financial instruments, is the lifeblood of our economy. Imagine it as a grand bridge, connecting those with surplus funds on one side and those in need of funds on the other. This bridge ensures that money and resources are effectively and efficiently allocated, fueling growth and prosperity. The Indian financial system plays a vital role in the economic development of our country. It's like the heart, pumping the lifeblood of finance to every sector and every corner of the economy, ensuring a healthy financial state. So, are you ready to explore this intricate system, to understand how it shapes and influences one of the fastest growing economies in the world? Stay tuned as we delve deeper into the intricacies of the Indian financial system. The Indian financial system, just like a well-oiled machine, relies on several interconnected parts. Let's delve into the four main components that ensure the system's smooth functioning: financial markets, financial institutions, financial services, and financial instruments. First up, we have the financial markets. These are the venues where buyers and sellers interact to trade financial assets like stocks and bonds. These markets are further divided into two types: the money market, where short-term, high-liquidity financial instruments are traded, and the capital market, where long-term securities like stocks and bonds are dealt with. Next, we come to financial institutions. These are the pillars that support the entire financial system. They include commercial banks, credit unions, insurance companies, and more. They act as intermediaries, facilitating transactions between savers who have surplus funds and borrowers who require these funds. Moving on, we have financial services. These are the services offered by the financial institutions to help individuals and businesses manage their finances. They include fund transfers, loan services, investment advice, and insurance services, to name a few. These services make it easier for individuals and businesses to navigate the financial landscape. Last but not least, we have financial instruments. These are the tools or contracts through which financial transactions are carried out. They include shares, debentures, bonds, derivatives, and more. These instruments are crucial as they help to transfer funds from those who have surplus money to those who need it. So, how do these components interact? Well, imagine this. A business needs funds to expand. It issues shares in the capital market. An individual, guided by the financial services of a bank, decides to invest in these shares. The bank, acting as a financial institution, facilitates this transaction. The shares, being a financial instrument, become the medium of this transfer of funds. As we can see, these components form the backbone of the Indian financial system. Scene script: have you ever bought a share or bond? If yes, then you have already been part of the financial market. The financial market, in simple terms, is a marketplace where buyers and sellers trade assets such as equities, bonds, currencies, and derivatives. It's like a big shopping mall, but instead of buying clothes or electronics, you're buying and selling financial instruments. Now let's dive a little deeper. There are two main types of financial markets in India: the money market and the capital market. The money market is like the express checkout lane. It's where short-term, high-liquidity money dealings occur. This market helps businesses and the government to manage their short-term liquidity needs. Some common instruments traded here include treasury bills, commercial papers, and certificates of deposit. On the other hand, the capital market is where you go for the long haul. It deals with long-term securities such as stocks and bonds. The capital market is further divided into the primary market, where new securities are issued, and the secondary market, where existing securities are traded. If you've ever heard of the Bombay Stock Exchange or the National Stock Exchange, you're already familiar with part of the capital market. These stock exchanges are like the bustling bazaars of the financial world, where shares of public companies are bought and sold. Then there's the bond market, often referred to as the debt market. It's where borrowers issue bonds to raise funds from investors willing to lend them money for a certain period. And let's not forget the forex market, where currencies are traded. It's like a global money exchange, but on a much larger scale and operates round the clock. Each of these markets plays a crucial role in the Indian financial system. They help in mobilizing and allocating resources efficiently, determining price levels, and providing avenues for investments and savings. The financial markets are the lifelines of any economy, providing the necessary liquidity and platform for trade. So whether you're a business owner, an investor, or simply someone interested in finance, understanding these markets is key to navigating the world of finance. Banks, insurance companies, mutual funds, these are all examples of financial institutions. But why are they so important? To answer this, let's delve into the role of financial institutions in the Indian financial system. These institutions serve as the backbone of the economy, playing a pivotal role in the flow of money and enabling the overall functioning of financial markets. Imagine the economy as a giant machine. Financial institutions are the cogs and gears that keep this machine running smoothly. They collect funds from individuals and businesses with surplus money and channel those funds to those in need of them. This process, known as financial intermediation, ensures that money keeps flowing in the economy, fueling growth and prosperity. Now, let's take a closer look at some of these institutions. Banks, the most common type of financial institution, accept deposits from people and extend loans to those who need them. They play a crucial role in maintaining the country's money supply and contributing to economic stability. Next up, we have insurance companies. These firms provide a safety net for individuals and businesses against unforeseen losses. They pool risks and provide compensation for the loss suffered, ensuring economic stability and continuity. Mutual funds, on the other hand, pool money from various investors to invest in a diversified portfolio of stocks, bonds, or other assets. They enable individuals with modest means to participate in the financial markets and reap the benefits of diversified investments. Development banks and non-banking financial companies also play a significant role. They provide long-term loans and advances for industrial, agricultural, and infrastructure development, thereby contributing to the country's economic growth. In essence, financial institutions act as intermediaries, facilitating the efficient allocation of resources. They help in mobilizing savings, providing risk management services, and aiding in wealth creation. Their role is crucial in maintaining economic stability and fostering growth. So we can say that financial institutions are the pillars of the Indian financial system, supporting its smooth functioning. Ever used a credit card or invested in a mutual fund? These are examples of financial services and instruments, and they play a critical role in our financial system. Let's dive deeper into what financial services and instruments really are. At their core, financial services are economic services provided by the finance industry. These services encompass a broad range of businesses that manage money, including credit unions, banks, credit card companies, insurance companies, and even some government-sponsored enterprises. But what makes these services so significant? Well, financial services facilitate transactions in our economy, allowing for the seamless movement of money from one party to another. For example, when you use a credit card, the card company pays the merchant on your behalf, effectively lending you the money for your purchase. This service allows you to buy now and pay later, providing a level of financial flexibility that would be impossible without such a service. Now let's talk about financial instruments. These are contracts between parties that create a financial asset to one entity and a financial liability or equity instrument to another. Common examples include loans, insurance policies, equities, and bonds. These instruments play a pivotal role in our economy by facilitating investments. For instance, when you invest in a mutual fund, your money is pooled with that of other investors and used to buy a diverse portfolio of stocks, bonds, or other assets. This allows you to benefit from the potential returns of these investments without needing to buy each one individually. In essence, financial services and instruments enable economic growth by providing mechanisms for borrowing, investing, and managing risk. They allow individuals and businesses to access funds, invest for the future, and protect against unforeseen circumstances. In the Indian context, they play a crucial role in mobilizing savings, channeling them into productive investments, and promoting entrepreneurial activity, thereby contributing to the overall economic development of the country. Financial services and instruments, therefore, are the tools that keep our financial system running. Now that we have a basic understanding of the Indian financial system, let's summarize. We started by introducing the Indian financial system, a complex yet harmonious interplay of markets, institutions, and financial instruments. We then delved into its key components, understanding how they contribute to the overall functioning of the system. We explored the financial markets, the bustling hubs of economic activity, where securities like stocks and bonds are bought and sold. We also discussed the role of financial institutions, the pillars that support the system, providing necessary services like loans and deposits. Lastly, we touched upon the significance of financial services and instruments, the tools that enable smooth financial transactions and risk management. All these elements work together, creating a robust and dynamic financial system that fuels India's economic growth and development. Remember, understanding the financial system is the first step to becoming financially savvy. So keep exploring, keep learning,